of 2023. And that should be question number 5. Should be question number 5. Yes, I hope you are there. So if you have the question with you, please confirm. Please confirm. If you have the question with you, please confirm. Okay. So what are we told in this question here? So we are told the foreign trial balance related to be delimited as at 31st of December 2022. So we are given property at costs, and we are told included within that property is a building whose cost is 400,000. We have the plant at cost, motor vehicle at cost, office equipment at cost. We have accumulated depreciation for building, plant, motor vehicle, office equipment. Then we have inventory on 1st January 2022, purchases at cost, distribution cost, administrative expenses, revenue, trade receivables and trade payables, bank balance, deferred tax, current tax, and the bank interest. Then we have the ordinary share capital share premium, retained profit on 1st January 2022, interim dividends which were paid, and then we have the suspense account. Then we have some additional information number 1 all the way to note number 6. And then what are we required to do? We are required to prepare the foreign financial statement presented in a suitable format for publication. Number 1, we are required to prepare the statement of profit or loss for the year which ended 31st of December 2022. Roman 2, statement of changes in equity for the year which ended 31st of December 2022. And Roman Part C, we are required to prepare the statement of financial position. So before we prepare what is required here, I want us to go through the additional information. We see whether there are some workings which are required. We do those workings and we finally prepare what the examiner was requiring. So therefore, we will start by having some workings. And this is as per the additional information. So let's go to the additional information number 1. You see what we are told. Additional information number 1, we are told what? What are we told in the additional information number 1? In the additional information number 1, what are we told there? We are told during the year which ended 31st of December 2022, which is automatically the current year, BD Limited disposed of an item of plant for a cash proceeds of 20 million, which has been credited in the revenue account. No other accounting entries was made. The plant had a cost of 39.7 million and accumulated depreciation of 15.86 million. So we are told any gain or loss on disposal of the plant should be included within the cost of sales. And then we are told it is the policy of the company to provide a full year depreciation in the year of the asset purchase and none in the year of disposal. So in that case, we are given information about an asset which was disposed. And there are two, I think, two adjustments we are going to make in relation to that, because we are told that this item of plant was sold for 20 million. Now, this 20 million, we are told, is included within the revenue. So it is obvious that once the company sells an asset, the amount received from the sale of asset, this should not be treated as part of the revenue, should not be treated as part of what? Of the sales. And therefore, this amount of 20 million, this amount of 20 million, which was received from the disposal of the plant, 20 million, this one will be deducted from the revenue. This one will be deducted from the company's what? Revenue, because we are told this 20 million was included within the revenue. It was credited in the revenue account. It's also important for you to note, if you go to the requirement, to the trial balance, it is important for you to note that trial balance which you are given, if you check on the figures up there, you'll be able to see that those figures are in thousands of shillings. So therefore, for us to be consistent, we must work with all our figures in thousands of shillings. In any of the figure we have from the additional information, we must omit the last 3 zeros. We must omit the last 3 zeros. Yes, we must omit the last 3 zeros. The last 3 zeros. Yes, I'm trying to make some changes on my camera here. I don't think it is that clear, but it should be now. It should be now. It should be clear now. Should be clear. Should be clear. Yes, it should be clear. Okay. So therefore, what you have said is that this particular amount, we will deduct it from the revenue. Number two, anytime the company sells an asset, disposes an asset, you must compute whether the asset was, you must determine whether the asset was sold at a gain or at a loss. And actually, we do that by preparing an account which is called the disposal account. So therefore, what we need to do is basically to prepare the disposal account, and we determine whether this asset was disposed at a gain or at a loss. Although in this case, let's not use the disposal account. Let's not use this account. Let's just compute this directly. To compute the gain, or basically the loss on disposal of an asset, we take the sales proceeds. Our asset was sold at how much? And then we deduct the net book value, which is the same with the carrying amount. We know that the net book value of an asset, this one is equal to the cost minus the accumulated depreciation. So if you get, after taking this minus this, if you get a positive figure is a gain, but if you get a negative figure here, is what? Is a loss. So therefore, let's compute this. We will take the sales proceeds, and basically the sales proceeds is this particular amount at which our asset was sold at, 20 million. And then to that, we proceed and we less the net book value. So the net book value, we are saying, is the cost minus accumulated depreciation. If you check on the information we have in paragraph, in note number one, sentence 2, we are told no accounting entries was made. The plant had a cost. We are given the cost. I want us to compute this one. We take the cost, which is 39,700,000. That was the cost, and accumulated depreciation of 15,860,000. So this now will give us the net book value. So therefore, we take 20,000 minus this net book value. So how much would be our net book value here? How much would be our net book value? The net book value for this item. So that would be 39,700 minus 15,860. So what are you getting? I'm getting a figure of 23,840. Is that what you're getting? Rusia, Helen? Is that what you're getting? Hassan, Virginia, Raphael? Is that what you're getting? Yes. So it basically means that this particular asset here was sold then at a loss, because if we take this minus this, we will get negative what? We'll get negative 3840, which basically is a loss on disposal. So being a loss on disposal, this one will be included within the cost of sales. Within the cost of sales, it will be added to the cost of sales. It will be added to the cost of sales. So I think those is what is required. One, we have said this amount of 20 million, which was included within the sale. We will less that from the sales. Also, in this case, we have computed the loss on disposal, which you have said will be added to the cost of sales. So let's move to note number 2. And you're told the depreciation on property, plant, and equipment is to be provided and allocated as follows. So we are given the 4 assets: buildings, plant, motor vehicle, office equipment. We are given the rate for computing the depreciation, the basis of computing the depreciation, and how that depreciation will be classified. So let's compute those particular depreciations for the current year. That should be our working number 2. Depreciation. So we start by computing the depreciation on buildings. Depreciation on buildings. In this case, we are told this will be 2.5%. Using which method? Using the straight line. So you have to recall, under the straight line method, we compute the depreciation based on cost. Under the reducing balance method, we compute depreciation based on the net book value. So therefore, for building, we will take 2.5% of the cost. What is the cost of the buildings? The cost of the buildings, this one, you should get it in the trial balance. The first item within the trial balance, we have property. And property we know comprises of land and building. This is something I said in our previous class. Property comprises of land and building. So in this case, we are told the cost of buildings is 400 million. It automatically means that because the total cost of the property is 600 million, the cost of land is 200 million. But in our case, we're interested with this. We're interested with the cost of the building. So the cost of the building in this case is 400,000. Remember, we are working with all our figures in thousands of shillings. In any figure, we are omitting the last 3 zeros. So let's get 2.5% of that. 2.5% of this will give us what? 2.5% of this. What are you getting? What are you getting here? Are you getting 10,000? Yes, 10,000. That is the figure I'm getting from Helen. That is the figure I'm getting from Lucia. Okay. So then from there, basically, even before we proceed to compute the other depreciation, we are told that this depreciation here of 10,000, this one would be classified as part of the administrative expenses. So let's move and compute the depreciation on plant, which will be 10%. 10%. Which method is used here? The reducing balance method. So under the reducing balance method, we compute depreciation based on the net book value. So we need to compute the net book value of the plant. How do we compute the net book value? So we will take the cost, because this one is equal to the cost minus the accumulated depreciation. So therefore, the net book value of the plant will be equal to the cost. The cost is given in the trial balance. The cost is given in the trial balance. Can you see the cost? The cost is the second item within the trial balance, which is 280,000 minus the accumulated depreciation, which is down there. The accumulated depreciation, who can be able to see the accumulated depreciation on plant? It is 111, 111, 160. 111, 160. 111, 160. 111, 160. 111, 160. So this will give us what? 280,000 minus 111, 160. And what are you getting here? Yes, I'm getting a figure of 168,840. Is that what you're getting? Please confirm. Hassan, are you getting this? Noor, are you getting this? Is that what you're getting? Is that what you're getting? Please confirm so that we move. Is that what you're getting? Yes. So we have 168,840. But now you have to remember, in the additional information number 1, there was a plant which was disposed. Can you remember this plant which was disposed? I want us to go back to note number 1. We see what we are told. Specifically, the last sentence of note 1. In the last sentence of note 1, we are told it is the company's policy to provide for the full year depreciation in the year of the asset purchase. What does that mean? It basically means that once the company has purchased an asset in a given year, the company will provide a full year depreciation. Even if the asset is bought 2 months, 1 month, or even 3 months to the end of the year, the company provides a full year depreciation. That's what you're told. And none in the year of disposal. So if an asset is purchased in course of the year, no depreciation for that asset. And therefore, I hope you can be able to recall, during the current financial year, the company disposed this plant. And we are told, whenever an asset has been disposed in a year, no depreciation to be provided in that year. So this net book value here comprises the net book value of this plant which was disposed. So what we need to do, before we compute the depreciation, we need to eliminate the net book value of this plant which was disposed. The net book value of this plant which was disposed is basically what we have computed here. Remember the net book value. This is the net book value of the plant which was disposed. So therefore, we left it here. We left 23,840. So why are we doing that? Because as per note number 1, the last sentence, we are told no depreciation in the year of the asset disposal. So if an asset is disposed in course of a certain year, no depreciation to be provided in that year. Sasa? Yes. So this now will give us what? We take this one minus this, minus 23,840. which will give us 145,000, and then we get 10% of that. So 10% of that will give us what? Will give us 14,500. And then this depreciation here then will be classified as part of the cost of sales. Will be classified as part of the cost of sales. Will be classified as part of the cost of sales. Will be classified as part of the cost of sales. Is that point clear? Have we understood where we have done that? Zipporah, Lucia, Helen, Noor. Is that point clear? Is that point well understood? If it is well understood, let's move and compute the depreciation for the other asset. So we are still in note number 2. Let's compute the depreciation on motor vehicles. Motor vehicles, which is equal to 20% of what? 20% on street train. Street train, we compute the depreciation based on the cost. What is the cost of motor vehicles? Motor vehicles, basically this is that item within the trial balance, which is 70,000, and this will give us 14,000. So how should this depreciation be classified? As per note number 2. This one will be considered as part of the distribution costs. So we also compute the depreciation as per note number 2 on office equipment, which will be 12.5%. 12.5% of the costs, because the method to be used there is the street train. So the office equipment, the cost for that is 40,000. 40,000. So what would be 12.5% of this? 12.5% of this. This will give us what? Is it 5,000? 5,000. Yes, 5,000. And basically this one still will be part of the administrative expenses, part of the administrative expenses. So we are done with that point. We are done with that point. I want us now we move to point number 3. In point number 3, we are told it is discovered that the former financial controller of BD Limited engaged in fraudulent financial reporting of shillings 12 million of the trade receivables. Okay, let's take that point again. We are told it has been discovered that the former financial controller of BD Limited engaged in fraudulent financial reporting. Shillings 12 million of the trade receivables are non-existent and need to be written off. Of this amount, 7 million relates to the year which ended 31st of December 2022, which is now the current year, while the balance or with the balance relating to the prior period. So basically, we are told in that point, the former financial controller of this company was involved in fraudulent financial reporting. Fraudulent financial reporting, in very simple terms, we refer to this as cooking the books of account. If, for example, as an accountant, you want to show the company is financially stable, you may overstate the assets. You may overstate the asset, or basically you can overstate the revenue. So that's what the financial controller did. So within the trade receivables, he included 12 million, which is non-existent. So no debtors who owe the company an amount of 12 million. And we are told this amount has to be written off. That amount has to be written off. So the working 3 here will be the trade receivables. The trade receivables, which are to be written off. So the trade receivables to be written off basically is an amount of 12 million. So we are told 7 million of this related to the current year. And basically this one will be treated as an expense, will be recognized as an expense within the current year. Remember, what we said is that when preparing a statement of profit or loss for publication purpose, we classify the expenses into 5. Now, this particular amount which was written off, we have to determine it will be classified as part of which expenses. Is it part of the cost of sales? Is it part of the distribution, admin, finance, or other expenses? Now, because this particular amount has been written off as a result of a decision made by the management of the company, this one we included within the administrative expenses. It is an amount which has been written off as a result of administrative decision, as a result of decision made by the management. So this one will be added within the administrative expenses. And then the other amount, which is 5,000, which relate to the previous year, this one will be adjusted in the retained earnings, when preparing the statement of changes in it. Could be done in the previous year, but they were not done. They should be adjusted to the retained earnings at the start. Because this was this amount of 5 million was supposed to be recognized or was supposed to be accounted for by the company as an expense in the previous year, but it was not accounted for. So this one we will deduct it. This one we treat it as an administrative expense, and then the full amount, this one of 12, this one automatically will be deducted from the trade receivables. The trade receivables of the company will be reduced with what? Will be which is required for that amount. So let's move to the other note. Let's move to the other note. We move to the other note, we see what we are told. Note number 4. Note number 4 is all about IS. As I can see, we have something called the current tax. Can you see the current tax? And actually, we are told that that current tax is a debit balance. So how much is the current tax in the trial balance? The current tax in the trial balance is how much? Current tax in the trial balance. Current tax in the trial balance, can you see that? Current tax in the trial balance. Yes, so I'm told that current tax in the trial balance is an amount of 2,600. 2,600. Now, take into account this amount in the trial balance, it appears on the debit column. What is this? Is it over or under provision? What is this? Based on our previous discussion, is it under or over provision of tax? Over or under? I'm told by Zipporah it is under, by Lucia it is under. Yes, automatically this one is under provision. Is under provision. We said if that amount appear on the debit column of the trial balance, it is under provision. If it is appearing on the credit side, we say this what is over provision. We say tax under provision in the previous year should be brought to the current financial year and should be added to the current year's estimated tax liability. So in the other sentence of note number 4, we are told a provision for current tax for the year which ended 31st of December 2022 over 52 million is required together with a decrease in deferred tax provision of 3 million. So basically what we need to do here is, first of all, we compute the amount of current tax, which will be taken to the income statement. And we say to compute this one, we take the estimated tax liability for the current year, which you're told is 52 million. And then we adjust this with the over or under provision of current tax from the previous year. Remember, in the previous year, there was under provision, which we should add to this. So to this, we should add what? 26. And basically now that will give us what? That will give us a total amount of 54,600. So this is basically what we will recognize in the income statement or in the statement of profit or loss as the current tax. Still in the same point, we are told there was a decrease in deferred tax provision. There was a decrease in the deferred tax provision of 3 million. So how do we account for this? A decrease in deferred tax. How do we account for this? Who can be able to recall? Because what we said is that during the current year, what we account for in the income statement as far as the deferred tax is concerned is the increase or the decrease in deferred tax liability. So we are told there is a decrease in the deferred tax liability. So we say this one should be accounted for as what? In the income statement. Who can be able to recall? Zipporah, we said this one should be recognized as what? In the income statement. Remember the other question which we did, we had an increase in deferred tax liability. We accounted for that as a deferred tax. Actually, we had a decrease. we had a decrease. I can remember we had a decrease, and we accounted for that as a deferred tax income. So the same case, because there's a decrease in deferred tax liability, this one in the income statement, this one in the income statement will be recognized there as a deferred tax income. Will be recognized there as a deferred tax income. So we are done with that. Let's move to the other point. Number 5, we are given that we are told the inventory count as at 31st of December 2022 revealed the value of the inventory at cost was 85 million. So this is the closing inventory, no working which is required. In note number 6, we are told on 30th of December 2022, the company directors invited the current shareholders to subscribe for a right issue on the basis of 1 share for every 5 shares which were held at an exercise price of 15. So this is information about the right issue. And then you're told the CAM right price. The CAM right price is the market price per share before the right issue. The CAM right price on the last day of trading was shillings 20. And then you're told the proceeds from the fully subscribed right issue was credited in the suspense account. So basically in that case, we are told there was a right issue. And I hope you can be able to recall we said a right issue. This is the issue of additional shares to the existing shareholders of the company at a price below the market price. So what we need to do here is we compute how many shares were issued by the company during the right issue. And as per note number 6, we are told during this particular right issue, the company was to issue 1 share for every 5 shares which were held. So the company was to issue 1 share for every 5 shares which were held. So what we need to do is to determine how many shares were held before the right issue. So we take the ordinary share capital of the company. The ordinary share capital that should be around the 4th item or the 5th item from the bottom of the trial balance, which is 200,000. We want to know the shares which had been issued by the company before the right issue. We take the ordinary share capital. For us to be able to determine the shares, we divide that with the par value per share. The par value per share in that case is 10. So this will give us 20,000 shares. So these are the shares which were held before the right issue. So we need to determine how many shares were issued during the right issue, because the company was to issue 1 share for every 5 shares which were held. The shares which were held were 20,000. So we cross multiply, then we divide. So we have 1 times 20,000 divided that with 5. So this will give us the shares which were issued by the company during the right issue. So, and this will give us, is it 4,000 shares? 4,000 shares, is that what you're getting? 4,000 shares. Please confirm whether you're getting that figure. Is that what you're getting? 4,000 shares? Yes, 4,000 shares. And as per note number 6, these shares we are told they were issued at a price of what? They were issued at a price of 15. Remember, during the right issue, the shares are always issued at a price below the market price. So the amount which was raised from the right issue was 4,000 times this, which was 60,000. And we are told in note number 6, this amount was credited in the suspense. You see, anytime the company has issued share, the amount which is received, that amount is always debited in the bank account. This amount is debited in the bank account and basically should be credited in the ordinary share capital. Part of it should be credited in the share premium. I'll be able to explain what we credit here, a total amount of what? Of 60. But instead of the company crediting this to account, the company credited the suspense account. And that's why in the trial balance, the last item, I hope you can see a suspense account, and the amount credited there was 60. So that this amount of 60 was credited here instead of being credited in the share capital and the share what? Premium. So we need to do the correct accounting entry, or to effect the correct accounting entry. And this amount of 60,000, we are saying it was supposed to be credited in 2 accounts: ordinary share capital and the share premium. Now, the amount which we credit in this account is always based on the par value per share. So we take the shares which were issued, which were 4,000, and then we know the shares were issued at 15. The amount which we credit in this account is always based on this amount here, the par value, not the issue price, but the par value, the amount which we have in the trial balance, the par value of 10. So the amount which is credited in the share capital is always based on the par. So therefore, the amount which was supposed to be credited in that account is 40,000. The amount which was supposed to be credited in this account, or the amount you are going to credit in this account, is equal to the shares which were issued times the amount of the share premium. The amount of the share premium is basically the amount which is above this 10 shillings. Remember, the shares were issued at a price of 15. How much is the amount is above 10? The amount above 10 is 5. So that one is a share premium. So an amount of how much? An amount of 20. So therefore, in preparing our statement of changes in equity, this will be added to the share capital. This one will be added to the share what? To the share premium. To the share what? Premium. And basically, in our case, I think we are done. So what we need to do now is basically proceed and prepare what is required. So we start with part A. So we have the title. The name of the company is BD Limited. And this is the statement of profit or loss. Statement of profit or loss, which is for the year, which ended 31st of December 2022. 31st of December 2022. 31st of December 2022. So here we need to have just a single column like that. We just need to have a single column. So have this so that we move together. Yes, so I want us we prepare this together. I hope you already have the title with you. I hope you already have the title with you. And what do we start with here? Who can be able to remind us? Zipporah, what do we start with here? In preparing the statement of profit or loss, we start with what? We start with what? We start with the revenue. We start with the revenue. So the revenue, that one is always given in the trial balance. That one is given within the trial balance. So revenue, how much is the revenue? You have to recall the revenue will have to be adjusted because this amount which was received from the sale of the asset was included within the revenue. So once the company sell an asset, that is not considered as part of the sales. So the revenue I'm told here is an amount of how much? Is an amount of 1123,500. 1123,500. So to this we less this amount of 20,000, which was included within the revenue. And this will give us an amount of how much? This will give us 1103,500. 1103,500. Is that what you're getting? Is that what you're getting? ABS, please confirm. Please confirm. Are you getting that? Yes. So having that, we need to move and we compute the cost of sales. You have to recall, how do we compute the cost of sales? Cost of sales, this one is equal to opening inventory plus purchases minus closing inventory plus depreciations plus the loss on disposal. Because in our case, we are not given the cost of our sales. We have to compute that. So this cost of sales, we go back to the trial balance, and below the accumulated depreciations, we have the opening inventory. So the opening inventory is an amount of 138,000. To that we add purchases. Purchases is below that opening inventory. which is an amount of 667,000. 667,000. And then to that, we less the closing inventory. I hope you can remember closing inventory is in note number 5. Note number 5. So we less 85,000. We less 85,000. And then to this, we add various depreciations. So from these depreciations, which are computed in working 2, some depreciation should be included as part of the cost of sales. One of it is this depreciation on plant, which is 14,500. Do we have any other? This part of admin, this part of distribution, this part of admin. Yes. So no any other depreciation. And then finally, we add the loss on disposal. I hope you can remember here we have a loss on disposal, which we said will be included as part of the cost of sales. This one. So we add 38.40. So that is how we compute the cost of sales, which we take to the last column, So this will give us what 138,000 plus 67,000 minus 85,000 plus 14,500 plus 38.40. And I'm getting a figure of what here? I'm getting a figure of 738, 340. 340. Is that what you're getting? Are you getting that? If yes, please confirm. Yes, so that is confirmed by 𝐉𝐻𝐂𝐔𝐒. Are you getting the same? Are you getting the same? Helen, Lucia, Raphael, are you getting the same? So if you're getting the same, we need to move and we compute the gross profit. The gross profit should be the difference between those two values. Give me the gross profit. How much is the gross profit? The gross profit I'm getting 365. 160. 365, 160. So to this, then we proceed. Please confirm whether you're getting those figures. Are you getting those figures? Are you getting those figures? Yes. So then to this, we proceed, we add other incomes. Remember, we say that when checking for the other incomes within the trial balance, we check the items appearing on the credit side. So in the trial balance on the credit side, which incomes do we have? So I think on the credit side, I can see accumulated depreciations. Those are not incomes. Down there, I can see revenue, trade payables, bank balance, deferred tax, and the bank balance. And then on the other side, I can see share capital, share premium, retained profit, and suspense. So in that case, we don't have any other income. We don't have any other income. So to this, then we proceed. And we less now the expenses. Maybe first of all, you can get the total incomes. 365, 160. So we less the expenses. Remember, this is our total incomes. So for the expenses, we can start with the distribution cost. The distribution cost, we take the amount given in the trial balance. And the distribution cost is given below the purchases. I hope you can see that. Which is an amount of 44,000. That is the distribution cost, which is given within the trial balance. Given within the trial balance. And I hope my video is clear from your side. Or is it fluctuating? I can see some information on my screen that my internet may not be stable. Helen, Raphael, 𝐉𝐻𝐂𝐔𝐒, is my video clear from your side? Is my video clear from your side? Okay, so if it is clear, then let's continue. So now to this distribution, we need to add certain depreciations. So like this depreciation on motor vehicle will be included here. Will be included there. Then this one is admin, this one is admin. Okay, so we get the final figure, which is 58,000. Then from there, we proceed and we take into account the administrative expenses. So the administrative expenses, we take the amount given in the trial balance. which is below distribution cost, and that is that 93,500. So to this, we first of all include this depreciation on buildings, 10,000. The depreciation on office equipment, 5,000. 5,000. And then there is something else to be included here, and that is this amount of 7,000, the trade receivables which were written off. So we also add 7,000. 7,000. I don't think we have any other adjustments. So then we get the final figure. We get the final figure. We get the final figure. So we have 93,500 plus 10,000 plus 12,000 plus 12,000. I'm getting a figure of 115,500. 115,500. 115,500. 115,500. Is that what you're getting? 115,500. Yes, that is confirmed by 𝐍𝐿. That is confirmed by 𝐍𝐿 there. So then from there we need to record the other expense, which is basically the finance cost. Now for the finance costs here, I think what we have is the bank interest. Just like the other question which we did, we have the bank interest, and that bank interest we said we consider it here as part of the finance cost, and that is an amount of 2,400. 2,400. Then from there we will proceed and we check whether we have any other expense. We check whether we have any other expense which is not included within the cost of sales within distribution, admin, or finance cost. Maybe we can check that from the trial balance. Remember, you said all expenses in the trial balance, they have a debit balance. So let's check the items in the trial balance or appearing on the debit column. So up there, we have property, plant, motor vehicle, office equipment. All those are assets. Down there, I can see we have inventory, purchases, distribution, admin. We have dealt with those. Down there, I can see we have receivables, current tax, bank interest, and then interim dividends. So basically, none of those are expenses. And then from the workings which we have done here, we have dealt with this. We have dealt with all these depreciations. We have dealt with this. This income tax will be adjusted to the profit before tax. These are a right issue. It basically means that in our case, we don't have any other expense. We don't have any other expense. So what we need to do now is we get the profit before tax. We get the profit before tax, basically by checking the total incomes minus those three expenses. Minus those three expenses. So 365,160 minus 58,000 minus 115,500 minus 2,400. Yes, what are you getting here? What are you getting here? I'm given a 62 to 60 by Lucia. Lucia, is that correct? 189 to 60. 189 to 60. 189 to 60. That is the same amount I'm getting there. Lucia, please confirm your figure. Yes, now to this we proceed and we make adjustment for income tax expense. Income tax expense. Now remember, you say that this income tax expense, this one basically comprises of two values or two components of taxes. Two components of taxes. It comprises of the current tax, which we computed here, and the deferred tax. So let's first of all we consider this one. the current tax, and the current tax is this amount which we computed here, this one, which is 50,4,600. And then also this one comprises of the deferred tax. And what we have here is the deferred tax income. So the deferred tax income deferred tax income. That one should be added here, and it's basically an amount of 3,000. So because it's an income, we add it to our profit. We add it to the profit here, and basically we get the profit for the year. The profit for the year, or basically the profit after tax. The profit for the year or the profit after tax. Yes, so that will be how much? Minus 54,600 plus 3,000. Plus 3,000. That is coming to 137,660. 660. That is what I'm getting, yes. So then to this, we said we proceed and we add the other comprehensive incomes. Other comprehensive incomes. These other comprehensive incomes include the gain or loss, the revaluation gain or loss on things like PP. If you check on this question here, we don't have any revaluation gain or loss on what? PP. So meaning that the total comprehensive incomes remain 137,660. Remains 137,660. So that's what was required in part A of that question, and the marks which were allocated there were 6. So these are basically the items which will give you those 6 marks. So that and that, the expenses, our 3 expenses, basically the tax like that. So let's move to part B, and we are required to prepare the statement of changes in equity. The statement of changes in equity. So remember, a statement of changes in equity, this one is prepared basically to show the changes in the various items of equity. And therefore, we said in preparing this statement of changes in equity, we always start with the details column. And then we need to go back to the trial balance which are given. We see which items of equity was this company having in this year. So we have various items of equity. Actually, we said equity comprises of share capital and reserves. So the first item of equity, I can see ordinary share capital. Below ordinary share capital, I can see share premium. Maybe you can just write that in full. And then from there, we have the retained profit. The retained profit. Do we have any other component of equity? Any other component of equity? I don't think so. And then finally, we have the total column. It's also important for us to indicate here that our figures will be in thousands of shillings. So what do we start with here? We always start with the opening balances. We start with the balances brought down. The balances brought down, these are the balances we have in the trial balance. 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 Someone is saying my Mwalimu's board is not clear. Is my board clear? So please confirm that as we continue. So we record the opening balances. So for the share capital, this is 200,000. Share premium is 50,000. Retained earnings is 223. 640. 640. Yes. I think the internet, I think it is fluctuating. I don't know what is happening, but I don't think it is that bad. So let's get the totals. We have 250 plus 223. 640. 640, which will give us 473. 640. 473. 640. Then what do we need to do? We need to record the various items or the various transactions which occurred during the current year, and basically which affect these items of equity. Maybe we can start with what? Let's start with what we have here. This statement of profit or loss which I have prepared. We said what we bring here is the profit after tax. The profit after tax, this one, or the profit for the year. And actually that one should be taken to this column, the retained profit or the retained earnings column. And then we take it to the last column, 137, 660. Then from there, we have this right issue. This right issue. And basically the right issue, we have said it will affect two items. We're going to add 40,000 to the ordinary share capital, 40,000, and then to the share premium, we add 20 there. The total amount is 60. We take it to the last column there. We take it to the last column there, Okay, so then from there, this will not affect that. We have this particular amount here of 5,000, which we said will be deducted from the retained earnings at the start. And actually this one, we refer to it as the prior year adjustment. The prior year adjustment. This was an item which was supposed to be adjusted in the financial statement for the previous year, but it was not adjusted. So this one will be deducted from this, because this was supposed to be, or this 5,000 was supposed to be recognized as an expense in the previous year, but it was not accounted for. So the profit of the previous year was overstated. So that's why we are deducting that from the retained profit from the previous year. Sasa? Yes. So we refer to it as the prior year adjustment. So let's check whether we have any other adjustment we need to capture there. This one will not affect that. The same case with this, but if we go back to the trial balance, I think there is somewhere I saw interim dividends. Yes, we have interim dividends. The second item from the bottom of the trial balance, we have interim dividends. Interim dividends. Interim dividends, we said dividends are always paid from the profit. So we left those dividends here, which is an amount of 10,000, and we take it to the last column. We take it to the last column. So I don't think we have anything else. So let's get now the balances at the end of the year, which then we transfer to our statement of financial position. So ordinary share capital, this will be 240,000. 240, this one will be 70,000. So we need to get the closing balance in the retained earnings or the retained profit, 223,640 plus 137, 660 minus 15,000. So what are you getting here? I'm getting 346,300. So then we need to get, is that what you're getting? Yes, that is confirmed. So let's get the total in the last column. The total in the last column, you may decide to add this plus this, or you work out that downward. You should get the same value. You should get the same value. I'm getting 656,300. 656,300. Okay, yes. So that is it. That what was required in that question, and equally the marks are located there were for those. These are basically the items which are marked: the opening balances, profit after tax, the right issue, interim dividend, and the prior year adjustment. Remember, the totals are not marked here. These totals are not marked. The same case with those totals. So we go to part C, where we are required to prepare the statement of financial position, a statement of financial position, statement of financial position. So here we start by recording the non-current assets. We start by recording the non-current assets, non-current assets. So for the non-current asset, remember, we always start by recording the tangible non-current asset. Tangible non-current asset in our question here, we basically have a number of them, including property, plant, motor vehicle, office equipment. But in this case, if you can be able to recall, we said when preparing a statement of financial position for publication purpose, we don't record those particular assets yet separately. So instead, compute the total net book value and basically include them here under the name of the property, plant, and equipment. So that's basically what we need to do. So here we will have the property, plant, and basically what? Equipment. So we will start with the first asset within the trial balance. The first asset within the trial balance is property. So property comprises of land and buildings. So we will take the cost, which is 600,000. First of all, I will deduct. Remember, we say that to compute the net book value of an asset at the end, you take its cost at the start minus the accumulated depreciation, which is in the trial balance. The accumulated depreciation in the trial balance, this is the accumulated depreciation at the start. And because you are not interested with the net book value at the start, to this also we have to less the depreciation for the current year. The depreciation for the current year is what we computed in working two. In working what? To depreciation for the current what? Year. Yes. So to this, we will less the accumulated depreciation at the start. Remember, this is the property which comprises of land and buildings. The accumulated depreciation at the start in the trial balance is 80. And then we also less the depreciation for the current year, which is this one, 10,000. That is basically for property. That is for what? For property. Then to this, I will add the net book value for plant. And for plant, in this case, we must recall that there was a plant which was disposed. So therefore, in terms of how we are going to compute the net book value for the plant, that one will be quite different. That one will be quite different because this plant which was disposed, do we need to include it here? Who can tell us? The plant which was disposed, should it be included here? Helen, Zipporah, should we include it here? The plant which was disposed, yes or no? Do we include it here? Once an asset is sold, do we include that asset here? Yes or no? Automatically no. So therefore, in terms of how we are going to compute the net book value for plant is quite different. So what we will do, we had computation, that computation here. This amount here, this was the net book value for the plant at the start. But in this case, we proceeded and we deducted the net book value of the plant which was disposed. And in that case, after taking this minus this, I can remember we had a figure of 145,000. So this 145,000 is the net book value of the plant at the start of the year. And that does not include the net book value of the plant which was disposed. So therefore, to compute the net book value of the plant at the end, I will take 145. This is the net book value of the plant at the start, excluding the plant which was disposed. And then because this is the net book value at the start, this amount of 145, I will have to less the depreciation for the current year only. The depreciation for the current year only for plant is how much? Is 14,500. So to this, I will less 14,500. So remember this now for plant. This for plant. This for plant. You can see the computation for that is quite different because of the plant which was disposed. Then let's move and compute the net book value for the other asset, which is motor vehicles. So to this, we will add motor vehicles. We need to compute the net book value for motor vehicles. The computation would be the same here. We take the cost of motor vehicles at the start, 70,000, minus the accumulated depreciation at the start, which is given in the trial balance, 42,000, minus the depreciation for the current year, this one, 14,000. So this is how we compute the net book value for motor vehicles at the end. So to this we add the net book value for office equipment. For office equipment, I'll do the same. I'll take the cost, which is 40,000. I will less the accumulated depreciation at the start in the trial balance, 15,000. I will also less the depreciation for the current year, which is 5,000. So this now will give us the net book value for the plant, for the office equipment at the end. And then I'll get the final figure, which will be the net book value for all tangible and current assets. So that will give us what? Maybe you can start with the property. So this 600,000 minus 90, 600,000 minus 90,000. And basically that should give us what? That should give us 510. What about plant? We take 145 minus 14.5, which will give us 130.5. What about motor vehicles? Motor vehicles, we have 70 minus 40 minus 14. I'm getting 16. And then office equipment, I have 40 minus 20. 40 minus 20, which will give us 20. So we add all these net book values. 510 plus 130.5 plus 16 plus 20. And this is the final figure I'm getting, 676,500. So confirm whether that is what you're getting. Confirm whether that is the figure you are getting. Are you getting that figure there? Are you getting that figure? That is confirmed by Helen. Okay. That is the total net book value for all property, plant, and equipment, for all tangible and current assets. Then from there, we need to check, do we have any other non-current assets, things like investment, things like goodwill, things like investment property? I don't think we have any. So from there, let's proceed and record the current assets. We proceed and we record the current assets. So for the current asset, we need the trial balance. We check the asset on the debit column. So we have dealt with all those items which are up there. Then downstairs, you can see we have inventory at the start. Remember, you said what we record here is the closing inventory, the inventory at the end. Then below that, we have purchases, distribution, admin. In fact, we have dealt with all those items. But downstairs, you can see we have the trade receivables. The trade receivables amount is 74.5. So someone may ask, which amount is the receivables, which amount is payables? So it is obvious that receivables, trade receivables is an asset. All assets have a debit balance. Trade payable is a liability. It should be the one on the credit side. So, but not to this amount of receivables. Remember, we said that there is this amount of 12 million, which we said should be deducted here. So from to this, we less 12 million. That will give us 62, 5 what? 62,500. Okay, so then below receivables, we have bank balance. It is also important for you to see that that bank balance is on which side of the trial balance? The bank balance. The bank balance is on which side of the trial balance? The debit or the credit? The bank balance. The bank balance is on the credit side. Being on the credit side, this is what? This is a bank overdraft. So being a bank overdraft, it will be a current liability. So then from there, we have deferred tax, current tax, bank interest, ordinary share premium, retained, interim, suspense. And then in the additional information, I think you have dealt with additional information number 1, 2, 3, 4. But if you go to the additional information number 5, we have the closing inventory. Closing inventory, we recognize it here as a current asset. And that is an amount of 85 million. Yes, note number 6 is about right issue. So meaning that we don't have any other assets. So we get the total assets. So we add whatever you have here to the current assets. So, and in this case, I'm getting a figure of 824,000. 824. Confirm whether that is what you're getting. Yes, that is confirmed by Helen. I've not gotten any answer from Raphael. Raphael, are we together? Virginia, are we together? Rusia, tuko pamoja? Yes, so once you get your answer, type it in the chat box so that I know whether we are together or not. Okay, so we move and now record items of equity. And for items of equity, remember, we have these figures here. So where do we get these figures? From this statement of changes in equity. So the first item is ordinary share capital. Ordinary share capital. So the ordinary share capital, this is now what we bring here to 40,000. So then from there we have share premium. Share premium, which is 70,000. Share premium 70,000. And then from there we have the retained profit. We have the retained profit. So the retained profit is 346, 300. And then we get the total equity. The total equity, which is 656, 300. 656, 300. Yes. So that's basically what we have as our total equity. So we need to move and basically record now the liabilities. So for the liabilities, we start with the non-current liabilities. We start with the non-current liabilities. Non-current liabilities. Non-current liabilities. So for the non-current liabilities, remember, we start by, or actually here, the non-current liabilities. We say that this one may take the form of bank loan, may take the form of debentures, may also take the form of what? Of deferred tax. And I think in our case here, we just have one, just like the other question. We don't have bank loan, we don't have debentures, we only have deferred tax. We have the deferred tax. Now, this deferred tax, there is a deferred tax which are given in the trial balance. The deferred tax given in the trial balance is how much? The deferred tax in the trial balance, which is below the bank overdraft. Who can see this figure there? The deferred tax, who can see the figure? The figure is how much for deferred tax? Is 32,400. But it's important to note that that deferred tax is the deferred tax at the start. That was we said even in the other question. But now what you have to recall is the information which are given in note number 4. In note number 4, we were told that during the current year, there was a decrease in deferred tax. So therefore, to compute the deferred tax at the end of the year, we will take the deferred tax at the start, 32,400. And then we are told this reduced during the current year with how much? 3,000. So this one reduced with 3,000. So we deduct 3,000. So this will give us 29,400. So 29,400 is basically the deferred tax at the end of what? Of the year. That is the deferred tax at the end of what? Of the year. We don't record the deferred tax at the start, but basically we record the deferred tax at the end of what? At the end of the year there. So we don't have any other non-current liability. We proceed and finally record what? The current liabilities. The current liabilities. So for the current liabilities, I think we have a number of them, and equally it's also important for you to recall that all liabilities have a credit balance within the trial balance. So we check the items on the credit side. So I can see depreciations down, depreciations. Then I can see revenue. Below revenue, I can see trade payables. I can see trade payables. Trade payables is an amount of 68,800. So and then below that, I can see the bank balance. But in this case, specifically, we can refer to that as a bank overdraft. So in most of the cases, the examiner will not tell you that that is an overdraft. That's why you are told it's just a bank balance. Majority of the students will come and record that here as an asset. So that's why you can see the examiner has not specified that that is a bank overdraft. But anytime you're given a bank balance on the credit side, that is always a bank overdraft. But if it was on the debit side, automatically is an asset here. So we have that bank balance. Then below that, I can see deferred tax. Deferred tax. Basically, I've dealt with that. Then on the credit side, still, I can see those items of equity. Ordinary share capital share premium, we have dealt with all those. What about in the additional information? In the additional information, we have dealt with note number 1, 2, note 3. But now note 4, we have the current tax. The current tax. Remember, we said what we recognize here is the estimated tax liability. Estimated tax liability for the current year before adjusting it with overall under provision. In note number 4, sentence 2, we are told a provision for current tax for the current year was 52. So that is what we recognize here before adjusting it with overall. And so I've not recorded the bank overdraft here. And the bank overdraft is the 15,500. So I think we are done with the note 4, 5, and 6. Yes. So basically we are through. So what we need to do is to get the total equity and liabilities. The total equity and liabilities. 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 Total equity and liabilities, what are you getting? Total equity and liabilities, what are you getting here? Yes, I'm told by Helen it will be the same with the total last 822,000. 822. So here we got 824. Does it mean it is not balancing? 822,000? $822,000? Is that what you're getting? That's what you're getting? 822? So you have a balance of what? 2,000. The totals are not reconciling. Whatever you have here and here is not reconciling. The amount are not reconciling, yes or no? So this was 824. So what is the difference between this and that? What is the difference? The difference is 2,000. I'm told this figure is wrong for PP. Did you got that figure for 676,500? Is that what you got? 676,500. Is that what is that the figure you got? What is the correct figure there, Raphael? For PP? The correct figure for PP should be what? Yes. Can you confirm this figure here? I've told you the figure which is wrong. Can you confirm whether that figure is correct? Confirm whether that figure is correct. Is that figure for PP correct? Is that figure for PP correct? Okay, so I'm told it should be 4 here. Should be 4 there. So mean that this one should be 822. Can the rest confirm whether that figure is correct? Can you confirm whether that figure is correct? Is that figure correct? No, yes. Helen Zipporah is saying yes. Yes means what? So 674 is correct. 674 is correct. Okay. So that basically that is it. Then that what was required as far as that question is concerned. The very good question on presentation of financial statements in accordance with IAS 1. And basically that should bring us now to the end of that topic. So what we will be able to do during our revision, we should be able to do more questions on this. Though during our revision, I'll try to show you how you approach these questions in an exam setup. In an exam, you can't do this question like this. You start with the workings and then you do this. You prepare what was required by the examiner. Remember, for example, in an examination, in an exam setup, you have to do this particular question here. You have to do this question here within what? Within less than 40 minutes, you should be done. So you can't be able to use this particular approach. So therefore, during our revision, we will try to look on maybe the shortcuts you can be able to use to handle this particular question, that you finish that question within 40 minutes. Within 40 minutes, you should be done, and actually you should get good marks as far as that question is concerned. So what I'll do, I'll basically give you an assignment, and then you attempt that question. But if you check on the past papers, I think except last sitting there was no question on this. You can be able to attempt any other question from 2024. I think including December of 20. I don't know whether in December 2024 2023 there was a question on this, but in the sitting of 2024 we have a number of questions. So you pick at least one of the questions, you attempt that, and then during our revision we will be able to come back to this particular topic here, and basically we look on more questions on this, because I said this is an area which I expect that it should be tested with sitting. If you check class sitting, there was no question on this. The question which was tested was on cash flow. Cash flow, that is what was examined. So I expect the sitting, there should be a question coming from this area, coming from this word area. Now, basically, for today, I think we will add a little bit earlier because we can't be able to start on something new. Our next topic will also be a very important one, the statement of cash flows. The statement of cash flows. If you check on the past papers, you'll also be able to realize that this is an area which is highly tested. Highly tested. So this is also an area you need not to miss the classes, because this is also a very important. Yes, I'm told by Rafael there is a question on December 2024. December 2024. Yes, can you attempt this particular question here? You attempt it, and once you are done, you can share with me your solution. I'll be able maybe to guide you. In case you're stuck somewhere, you can also get in touch with me. I'll be able to assist you on in terms of how to handle that particular question. Sasa, yes. So let's look at that particular point for today. Once we meet in our next class, we will be able to move and look on this. That is how to prepare a statement of cash flows. So remember, right now you should start now revising, because now I think the key area which is remaining is group accounts. Once we are done with cash flow, the key topic which will be remaining is group accounts. So once we are done with the group accounts, we will be done with the syllabus. We will be almost like 80% done with the syllabus. That's that? Yes. So someone is asking April 2023, note number 3. Note 3. April 2023. Yes. I don't have those past papers. My papers are up to August 2023. Okay, Zipporah, I think you can do this. Just share that note in the class WhatsApp group. I'll be able to guide you. Sasa, Rafael? The notes you want to be assisted, share that in the class WhatsApp group. I'll be able to assist you. Sasa? Yes, I'll be able to assist you to give the explanation in the class WhatsApp group. Is that okay? Is that okay, Rafael, Zipporah? Is that okay? You share that note. Share that note in the just a photo in the class WhatsApp group. I'll be able to assist you. I'll be able to assist you there. Zipporah, Rafael, is that okay? Okay, so I want us to stop at that point for now. We'll continue from there in our next class as we look on something else. So have a nice evening. We continue from there in our next class. immediately releases back that what asset. Mostly we say that this happens whereby a company owns an asset. The company maybe want to raise a huge amount of money, maybe to be invested in a certain project, and the company is maybe not in a position to issue shares, is not in a position to issue some debt instrument, or maybe that company is not able to go to a bank or maybe borrow what a loan. Therefore, the directors of that company maybe decide to sell one of the assets which is owned by that company, but because the asset is still used by the company, the asset will have to be leased immediately afterwards, after the sale. So therefore, in case of a sales leaseback transaction, we say, and this whereby a company will sell an asset, basically will sell an asset. We say the company which sells the asset is called the seller, and basically this asset will be sold to another company which is called the buyer. And immediately these two companies will enter into an agreement, or basically into a contract, that this company here will release back the asset to the seller. So meaning that once the asset is basically sold, the asset then will be released back to this particular company. So therefore, we say this company which is selling the asset is called the seller. This company which is buying the asset is called the buyer. Now, on the other hand, once these two companies have entered into this lease agreement, this company here, which now owns the asset, and which has leased back that asset, this company is called the lessor. Remember, in this case, we said the lessor. Basically, this is the owner of the asset. So if you are the owner of the asset, you are the person who is leasing out the asset. You are known as who? The lessor. And basically, the person who is given the right to use that asset is called who? The lessee. So therefore, this company will be known as the lessor, whereas this company here is called the lessee. So therefore, we can say in this particular transaction, that is in a sales leaseback transaction, we have two parties. We have two parties. Number one, we have the first party, who is called the seller lessee. The seller lessee. And actually, you say that these are the company or the entity which is selling the asset and immediately leasing back that particular good asset. So number two, we have the other party called the buyer lessor. So the buyer lessor is the company which is buying the asset and immediately leasing back that particular asset to who? To the seller lessee. Now, in this case, we are going to look on how this transaction is accounted for in the books of account of these two parties. So how does these two parties account for this particular good transaction? But even before we look on how this transaction is accounted for, according to this particular standard here, that is IFRS 16, for these two parties to account for this transaction, it is important to determine whether this transfer of the asset, or basically this sale of the asset, whether it is a true sale, or not. So that is the first thing the two companies need to determine. Is this a true sale or not? So basically, what does that mean? Now, according to another standard, which is IFRS 15, so in this case, a sale, this should be a true sale. So in this case, a sale of maybe an asset is deemed to have occurred, and whenever a company transfers the control of such an asset, and also the company has transferred the rewards, and basically the risks which are associated with what? With the asset. What does that mean? It basically means that in determining whether this is a true sale or not, what is required by each of the company here is to determine whether this is a true sale or not. In this case, we are saying a true sale will occur whenever the control of the asset is transferred. If this company here, which is selling the asset, transfer the control. So in this case, when we talk about the control of the asset, or basically the control, this basically we say is the ability of a company to direct the use of the asset. To direct the use of what? Of the asset. That is the definition of a control under this particular asset. So if this particular company here sell the asset, and basically that amount now to a true sale, it basically means that this particular company here, which has bought the asset, will be having the control of the asset. It will be in a position to direct how the asset will be what? Will be used. Number two, a sale is deemed to be to have occurred whereby this particular company transfers the risks and the rewards which are associated with what? With the asset. So therefore, for these two companies to be able to account for this particular transaction, the first thing which is supposed to be done by both companies here is basically to determine whether this is a true sale or not. That's the first thing. And in this case, we have said that this will amount to a true sale if it basically meets the criteria specified under IFRS 15. In this case, we have said a sale will be deemed to have occurred whereby this company transfer, number one, the control. It basically means that this company which has bought the asset will be having the ability to direct how the asset will be used. And number two, this company has transferred the reward and the risk associated with that particular what? Asset, associated with that particular asset. In that case, now the sale is deemed to have occurred. So if that is the case, then how should this company account for that particular transaction? So we look on how to account for this transaction if now this sale is basically a true sale. It basically meets these two criteria. So in this case, we are going to look on how this company should account for that transaction. So we look on how this is accounted for. Number one, in the books of the seller, in the books of the seller receipt, in the books of the seller receipt. Now, in the books of the seller receipt, we are saying, or basically, if now this is a true sale, this company has transferred the control, has transferred the risk and reward to this particular company. So how should this company account for that transaction? Number one, this particular company here is required to recognize the asset. And basically, this is very, very important. You need to understand this. So this particular company is required to recognize the asset. So what does that mean? So I explained this, I think, in the topic of financial instrument, and also in the topic of risks, I think, in our class number 2 or in our lesson number 2, I say to recognize an asset. Basically, this is to remove. This to do what? This is to remove the asset from the entity's statement of financial position. In this case, we are saying this company has transferred the control, has transferred the risk and reward to this company. So therefore, this company has to do what? To recognize the asset. That is the first thing. Number two, and this particular company here will also compute something called the gain, or basically the loss on what? On disposal. The gain or the loss on disposal. Basically, what we know is that once a company has sold an asset, there may be a gain or a loss arising from the sale of that asset. So how do we compute this particular gain or the loss on disposal? So what we do, we take the normal gain. So the normal gain, basically, if a company sell an asset, so how do we determine the gain or basically the loss? So we take the sales proceeds, we less the net book value, and this net book value, you have to recall, it is also known as what? The carrying amount. So this basically computes now the normal what? The normal gain. Now, once we have computed the normal gain, then we have to multiply this. We multiply this with the fair value minus the present value of the risk payment. And these formulas are very, very important. You need to understand them. So I hope you can see what we are doing. We are taking the normal gain or loss, normal gain or loss on disposal, which is equal to the sales proceeds minus the net book value. We are multiplying that with what? With the fair value. The fair value is the same with the sales profit. This is the same with the sales what? Proceeds. So this particular asset was sold at an amount of how much? The value at which the asset was sold at is the fair value or is the sales what? Proceeds. And then you less that, or to that you less the present value of the risk payment. So automatically, remember this company has sold the asset and then leasing back. Automatically, this company would be expected to be paying some risk payment. So we get the present value, but in most of the cases, this one will be given by the examiner. So and then we divide that with the fair value stroke the sales what? Proceeds, stroke the sales proceeds. So this is the first formula which is very, very important for you to understand as far as accounting for the sales risk back transaction is what is concerned. So you have said this company number one must recognize the asset remove that asset from its statement of financial position. Number two, that company will proceed and compute the gain or the loss on disposal. How do we compute that? We compute the normal gain or the loss times this. The fair value or the sales proceeds of the asset minus the present value of the risk payment. We divide that with the fair value, which is the same with the sales proceeds. Number three, this company here, that is a seller receipt, will also need to do what? We'll also need to recognize. We'll also need to recognize something called the right of use asset. The right of use asset. Remember, in our lesson number 1, we see that if, for example, you list an asset, then you recognize 2 items in your books of account. You recognize the right of use asset. You also recognize something called the risk liability. So this company has sold the asset and basically immediately list back that asset. So this company must recognize the right of use asset, and also it must recognize something called the risk liability. The risk what? The risk liability. So how do we compute these 2 values here? Number 1, in terms of how we compute this risk liability, this one is computed in the normal way. This one is equal to the present value of the minimum risk payment, or the present value of the risk what? Of the risk payment. Basically, this particular value here. The present value of the risk what? Payment. The normal way we compute the risk what? We compute the risk liability. Now, how do we compute this one? The right of use asset. If you can be able to recall what we did in our lesson number 1, to compute the right of use asset, actually in this case, in terms of how we compute this, there is a slight difference. So the formula which we use to compute this here, we take the previous carrying amount, or basically the previous net book value. So this is the net book value or the carrying amount of the asset before it was disposed. This particular asset which was sold, what was its net book value or what was its carrying amount? So we multiply this with we multiply this with the fair value, we multiply this with the present value of the risk payment, divided that with the fair value. Divided that with what? The fair value. Remember, in this case, we have said the fair value is the same with the sales proceed. Is the same with the sales what? Proceed. So this is basically the other formula, which basically you also need to understand. Very, very important. Those 2 formulas. That formula for computing the gain on disposal, and this formula for computing the right of use asset, they are very, very important. I've said to compute the right of use asset, we take the previous carrying amount of the net book value of the asset, we multiply that with the present value of the risk payment, we divide that with the fair value or the sales what? Proceed. So therefore, in case this particular transaction is a true sale, it basically meets these 2 criteria specified under IFRS 15. Then you're saying that this particular company will do those 4 things. 1, they recognize the asset. Number 2, recognize the gain or loss on disposal, which is computed using that formula. And then number 3, recognize the right of use asset, which is computed using that formula. And number 4, recognize the risk liability, which basically we compute in the normal way as the present value of the minimum risk payment, or as the present value of the risk of the risk payment. So this basically what is very, very important as far as this is concerned. So then let's move and look on how this company here, that is the buyer 𝐍𝐿, should basically account for this transaction if it is a true sale. If it is a true what? A true sale. So if it is a true sale, so how should this company account for this transaction? So if it is a true sale, it basically means that this company here, number 1, should recognize the asset. This company should do what? Recognize the asset in its statement of financial position. That's why we are saying this company here will have to recognize. This company recognize, remove that asset, because the control, the reward and the risk have been transferred to this company. And then this company, we are saying number 1, would basically recognize that asset. We know whenever a company has bought an asset, how should that company recognize that asset? Basically, debit the asset account and then credit the bank or cash account. So number two, this company then will proceed and account for this risk, account for the risk as either account for the risk as either finance or operating risk, as either finance or operating risk. And if you can be able to recall in our previous class, we looked on how the owner of the asset, that is the lessor, should account for these two types of risks. So number one, we say that if, for example, this is an operating risk, what the owner of the asset will account for is the risk rentals is receiving as part of the other incomes within the income statement. If it is an operating risk, but if it is a finance risk, we say this company here one will have to recognize the asset, and then number two, this company will have now to recognize something called the net investment in the risk. That's just what you need to remember. So if it's an operating risk, what this company will be accounting for are the risk rentals receivable. This one is recognized as part of other incomes within the income statement if it is an operating risk. But if it's a finance risk, we say this company will do what? Will recognize the asset, remove the asset from the statement of financial position, and number two, this company recognize something called the net investment in what? In the risk. So therefore, there is no change here in terms of how now the owner of the asset will be accounting for this risk with what we did in our previous class. If you can be able to remember what we did in our previous class, we looked on how the owner of the asset accounts for the finance and operating risk. So if this is basically a true sale, so then there is no difference in terms of how the owner of the asset will be accounting for that particular transaction. He will have to determine whether it is an operating risk or basically a finance risk using the criteria we discussed in our previous class, and then account for it as either operating or finance. So that is basically how this transaction should be accounted for if basically it amounts to a true to a true sale. Now, I want us to proceed and look on how we account for this transaction if the transaction does not amount to a true sale. But even before we proceed to that, is this clear understood? Because I want us to do a question on this. There is, I think, a question which was examined on this. So even before you move to that question, you must be able to understand what you have said here. So maybe I can just do a quick recap before I proceed and look on how we account for this transaction whenever it is not a true sale. One, we have said that in case of a sales leaseback transaction, this company will sell an asset and immediately lease back the asset. As a result of that, this company will be known as the seller, and because it's also leasing back the transaction immediately, it is called the lessee. So this company has bought the asset, it is the buyer, it is the owner, and therefore it is giving the right to use the asset, it is the lessor. So therefore you have said we have two parties. We have the seller, lessee, and then we have the buyer, lessor. Now we have said for these two companies here to account for this transaction, these two companies need to determine whether this is a true sale or not. And actually, you have said it will be a true sale if it meets the criteria specified at the IFRS 15. So IFRS 15 is something you did in a file. This basically governs how to recognize revenue from contract with customers. So how should a company recognize a how should a company recognize revenue arising from contracts which have been entered into with customers? So, and in this case, we are saying that this will amount to a true sale. Number one, if the control of the asset has been transferred by this company to this one, and number two, the rewards and also the risk associated with the asset have been transferred to this company. So, if it is a true sale, then this company, number one, we have said, will recognize the asset. Number two, it recognizes the gain or the loss on disposal. Number three, this company, because it is leasing back the asset, it will recognize the right of use asset, and you have to remember this formula here, and also it will recognize the risk liability. So those are like the 4 accounting entries which are made in the books of account of this particular word, a company. So if it is a true sale, this particular company 1 will recognize the asset because the control has been transferred to this company. Number 2, this company then will proceed and account for that particular lease as either finance or operating. So that's basically what you need to know. But here we have said what is very, very important are these formulas. These formulas which we have here, basically you must remember them. Then let's look on how this transaction will be accounted for if it is not a true sale. If it is not a true sale. So in this case, we have said this transaction will be regarded not to be a true sale, not to be a true sale if, number 1, the control of the asset is not transferred. The control of the asset is not what? Transferred. So it means that this company, despite having bought the asset, the company does not have the ability to direct how the asset will be used. The control has not been transferred. Number 2, this will not be a true sale whereby the rewards and basically the risks which are associated with the asset equally are not what? Are not transferred. They are not transferred. The risks and rewards associated with the asset still remain with this person. So if then that is the case, this transaction basically is viewed to be like a loan arrangement. So if it is not a true sale, this transaction then amount to like a loan what? Arrangement. A loan arrangement. So basically when we talk about a loan arrangement, this whereby, for example, you may be owning an asset, you approach a financial institution or basically a bank, and basically borrow money from them and use one of the assets which you own as a collateral security. So in most of the cases, the moment you're given that loan, what will happen is that the value, the current market value of the asset will be determined. And the loan which will be given, in most of the cases, will be equivalent to the market value of that particular good asset. And that's why you see that anytime, for example, you go to a bank here, and maybe you want to borrow like a loan, and maybe use one of the assets which you own as a collateral security. So in most of the cases, the bank must do evaluation of this asset. What is the current market value of this asset? And therefore, the amount of the loans they will give you, in most of the cases, will be equivalent to what? To the market value of that asset. So therefore, if this does not amount to a true sale, the control is not transferred, the risk and reward are not transferred, then you are saying that this is like a loan what? Arrangement. So in this case, the amount of the sales profits, which is received by this company here, that is the seller receive, the sales profit received, this one will be treated like a loan. In other terms, this one will be treated like a financial liability, or this will be recognized as a financial what? Liability, because now this company has sold an asset, it has been paid an amount of money equivalent to the fair value of the asset. So that amount of money which has been paid, we are saying that this one will be treated as a loan. Will be treated as what? As a loan. In other terms, this company will account for something called the financial liability. The financial liability, this one is equal to the sales profit. So how much amount was received after selling the assets? So that one will be recognized as a loan. Specifically, it will be treated as a financial what? Liability. So on the other hand, this company here will be deemed to have given this one a loan. So therefore, the sales profits, remember this is now how the transaction will be accounted for by this company, the seller receive. The seller receive, we are saying, will just recognize the sales profit as a loan. And because the asset has not, the control of the asset has not been transferred, this company will continue accounting for that asset. This company will continue accounting for the asset in its books of account, and then the amount it received as a sales profit, we are saying will be accounted for as what? As a loan. What about now these companies? What about now the buyer as well? So the buyer as well will account for the sales profits paid, the sales profits paid as a loan given, as a loan which has been given. So a loan which is given, this one should be accounted for as a financial asset. This one should be accounted for as a financial what? asset. So this particular company has given a loan to this one. It will account for the loan given as a sales what? Sorry, as a financial asset. This financial asset will be equivalent to the sales profit which was paid, which basically we are saying is that like a loan this company has given to this one. So basically this one is not a very, very common, but you may come across a theory question whereby you're required to explain how does these two parties in a sales leaseback transaction account for this transaction in case there is no true sale, in case the transaction does not meet the criteria specified at the IFRS what? 15. Sasa? Yes. So I think with that, even with that, we can look on a question. We can look on a question from a past paper. I don't know whether there is any question before we look on a question. Is that well understood? Before we look on a question? Before you look on a question, is that well understood? Is that well understood? Is that well understood? I'm told by Dan it is well understood. Yes. Is that well understood, Maureen? Before you look on a question from a past paper? Okay. Yes. So I'm told by Georgina is well understood. Okay. So let's look on a question. We have a very good question on that. A question which was tested in December 2021. December 2021, you go to question number 3A. December 2021. December 2021, question 3A. December 2021, question 3A. Question 3A. So are you there? Do you have the question with you? If yes, please confirm. Please confirm. Are you there? Are you there? Are you there? Do you have the question with you? Do you have the question with you? If yes, please confirm so that we move together. Do you have the question with you? Yes, are you there? Are you there? That is I need some confirmation. Okay. So what are we told here? What are we told? We are told Heri Limited sold a building at its fair value of shillings 112 million to a finance company on 31st of October 2020, when its carrying amount was shillings 78.4 million. So the building was leased back from the finance company for a 5-year period. The remaining economic useful life of the building was deemed to be 25 years, so it could be concluded that the control of the building had been transferred to the finance company. That information is very, very important, that when this company, which is called Heri Limited, sold the building to a finance company, in that sentence we are told the control was transferred. So if the control was transferred, then this transaction amounted to a true sale. So if it's amounted to a true sale, then you have to remember what you have said. So what should be recognized, how should the Heri Limited recognize for this, or recognize this transaction in its books of account? And then you're told the lease rentals are shillings 9,856,000 payable in annually in arrears. The interest rate implicit in the lease is 7%. The present value of the annual lease payment was shillings 40.32 million. Heri Limited recorded the cash proceeds. They recognized the building and recorded the profit on the sale of that 3.6 million in the statement of profit or loss. No other accounting entries have been posted. So what are we required to do? We are told with the reference to IFRS 16 leases and with the suitable calculations, explain the accounting treatment of the above transactions in the financial statement of Heri Limited. in or for the year which ended 31st of October 2021. So basically, it is important for you to note that here we have two companies. We have this company which is called 𝐻𝐍 Limited. This is basically the company which sold the building, and we are told the building was sold to a finance company, and immediately this company leased back that particular asset. Immediately leased back that asset. It basically means that this company here will be the seller, because it sold the asset, and after selling the asset, it leased back the asset. So this company is the seller, lessee, whereas this finance company is the buyer, lessor. Is the buyer what? Lessor. That is the first thing you need to know. And then we are told that the control of the asset was transferred. The control of the asset was transferred to this particular what? A company. So if the control was transferred, basically that amount to a true sale. It amount to a true what? Sale. So if it's a true sale, what have we said? We have said that this company, that is the seller, lessee, one will have to recognize that asset, remove that asset from the statement of financial position. 2, recognize the right of use asset. 3, recognize the lease liability. 4, recognize the gain or the loss on what? On disposal. That would we have said. Then in the books of account of this company, we have said 1, this company will recognize that asset, recognize the asset, and number 2, this company will then proceed and account for that lease as either operating lease or basically as what? As a finance lease. As a finance what? Lease. That's what you needed to remember there. But what are we requiring in our question here? So, or what was the examiner requiring? The examiner was requiring, with reference to IFRS 16 leases and with suitable calculations, explain the accounting treatment of the above transactions in the financial statement of which company? In the financial statement of 𝐻𝐍 Limited, basically for 1 year, the year which ended 31st of October 2021. So even before we do any computation, we can say number 1, or here we can say that this is a sales leaseback transaction, which amount to a true sale, which amount to a true sale, which amount to a true sale, Why? Since the control, or since 𝐻𝐍 Limited is the seller lessee, transferred the control of the asset, to the buyer, lessor. To the buyer what? Lessor. That is basically the first thing you needed to know, that this is a sales leaseback transaction, and it basically amounts to a true sale simply because the control of the asset was transferred. So if that is the case, then we have said that this company will basically account for those like 4 items. They recognize the asset, recognize the right of use asset, recognize the lease liability, and then recognize the gain or loss on disposal. So we can proceed and we say 𝐻𝐍 Limited will therefore number one we say they recognize the asset. They recognize what? The asset. Remember, in this case, the asset here is specifically a building. Is specifically what? A building. So that asset will be recognized. It will be removed from the statement of financial position of 𝐻𝐍 Limited. Number two, we have said that this company will also recognize the right of use asset. Recognize recognize the right of use asset, the right of use asset, right of use asset, right of use asset. So how do we compute this one? Because that is what you need to remember, the right of use asset. The right of use what? Asset. So we need to remember the formula here. So the formula we have said we take what? I hope you can be able to remember this. We have said we take the previous carrying amount. And in this case, we have said the carrying amount of an asset in other terms is known as what? What is the other name for this? Carrying amount of an asset. Carrying amount, I'm told by Faith, it is the net book value. Is that correct? Maureen? Georgina, is that correct? Benson, is that correct? Carrying amount is the same with what? Yes, carrying amount in this case, you have said it is the same with the net book value. The net book value. And then you have said we multiply this with what? With the present value of the risk payment. The present value of the risk payment, present value of the risk payment. And then we divide this with the fair value. The fair value, in other terms, we have referred to this as the sales proceeds. The sales proceeds. So these formulas we are saying are very, very important. So I want us, even before we move to the other item, which should be accounted for by 𝐻𝐍 Limited, we compute this. So can we go back to the question here? You tell me, before the asset was sold, what was its carrying amount? That information, we have it in paragraph, in sentence 1. Before the asset was sold, what was its carrying amount of the net book value? Can you see that net book value? As I'm told by this, it is 78.4. Yes, so we are told in sentence 1, 𝐻𝐍 Limited sold a building at the fair value of 112 million to a finance company on 31st October 2020, when its carrying amount was 78.4. That is the carrying amount or the net book value of the asset before it was sold. We multiply that with this, the present value of the risk payment, and that is also given somewhere. It is given within paragraph 1, the last sentence. Within paragraph 1, the last sentence, and is given as what? Is given as the present value of the annual risk payment is 40 million. And we can work with all our figures in million of shillings, 0.32 million, 0.32 million. And then we divide that with the fair value, which you have said is the same with the sales what? Proceeds. So our asset was sold at an amount of how much? Our asset was sold at an amount of how much? Can you see the sales proceeds? Can you see the sales proceeds? So this building was sold by 𝐻𝐍 Limited to a finance company at an amount of how much? Who can see that amount? Who can see that amount? Who can see that amount? Yes, that amount is within paragraph 1. The building was sold at the fair value of the sales proceeds of 112 million. So this is basically how we compute the right of use asset. The right of use asset. So this will give us an amount of how much? Compute that particular amount. You give me the final figure. Compute that amount. Compute that amount. So I'm told by Ismail, it will be 224 million. 224 million. Is that what you're getting? Please, you're getting 2-1. You're getting 2-1. Don't loud off, because I think the answer you're getting is in 3 decimal places. Don't loud off. Is it 224 or 2-1? It should be 224. 224, yeah? Yes. So then, other than recognizing this, number 3, we have said that this company, the seller 𝐻𝐍, will also recognize the gain or the loss on disposal. The gain or loss on disposal. But in this case, if you check the information we have in paragraph 1, We are given the sales proceeds. The asset was sold at 112 million, but its net book value was this. Its net book value was this. Automatically, this asset was sold at a gain. So therefore, this company will recognize the gain on sale. The gain on sale. How do we compute this gain on sale? You also need to remember this formula, very important. So we take the normal gain. The normal gain will be, we have said, is equal to the sales profits minus the net book value. We multiply that with the fair value minus the present value of the risk payment, and then we divide that with what? With the fair value. So let's compute this. Let's work out this. We compute this. So we take the normal gain. The normal gain will be equal to, maybe I can have the formula here. This one is equal to the fair value or the sales profits minus the net book value. So the fair value is 112. The net book value is this. So this will be equal to 112 minus 78.4. That will give us the normal gain. We multiply that with the fair value, which is 112 minus the present value of the risk payment. Present value of the risk payment is this, 40.32 million, minus 40.32 million, and then we divide that with the fair value. The fair value is 112. The fair value is 112 million. So give me the final figure there. You give me the final figure, So the final figure in this case will be the gain. Will be the gain on disposal. The gain on disposal. What are you getting here? What are you getting? What are you getting here? Yes, that is the amount I'm given, 21.504 million. 21.504 million. So that is basically how we compute the gain on sale to be recognized. And then finally, number 4, we have said the seller receipt will also recognize something called the risk liability. We'll also recognize the risk liability, and the risk liability, this one, risk liability, this is equal to the present value of the present value of the risk payment, or the present value of the minimum risk payment. And actually, this value has already been computed for us, though even if it was not computed, there is how we compute that. Remember, we say that in this case, we take the minimum risk rentals, we discount that using the interest rate implicit in the risk. The interest rate implicit in the risk is given in paragraph 1 in the second sentence from last, which is 7%. And then the risk payment. This payment is also given as 9,856,000. So naturally, remember that this particular asset was leased back for 5 years. The asset was leased back for 5 years. So to get this, which has already been computed for us as an amount of 40.32 million. So this one should be equal to this one. If it was not given, should be the present value of this. 98,56,000 times the present value interest factor of annuity at the rate of 7%, this one. And basically for 5 years. For 5 years. So we should give us the same value here. So remember the formula for computing this. So you should take 9856, and then the formula here is 1 minus 1.07 raised to power negative 5 all over R, which is 0.7. Can you confirm whether that will give us the figure we have up there? 40.32 million. Is that what you'll get if you work out this? 1.07 raised to power negative 5, 1 minus answer divided by, sorry, this should be 0.07. Yes, it's coming to around 41. I think this one has been rounded off, but it's coming to the same value. Are you getting the same value? Are you getting the same value? The same value, the same value? The same value, is that what you're getting? The same value? Just the present value of this. The present value of this. Or this times the present value interest factor at the rate of 7% for 5 years. So that should give us the same. That should give us what? The same. But I think in that case, the examiner had simplified the work by basically providing that value. By providing that value. Are you getting the same value? Are you getting the same value you want us to move? Are you getting the same value? The same value? Yes, yes. So, okay. So then let's proceed. Let's proceed, please. Let's proceed now. Let's proceed. So these are basically the what these companies should do. One, they recognize the asset, recognize the right of use asset, recognize the gain on the sale, recognize the lease liability. Then we need to proceed and we make the accounting entries. We show the accounting entries. The accounting entries which were made by this company on the date this transaction took place. Remember, this transaction took place at the start of the year, or when the date took place. It basically took place on 31st of October, 31st of October 2020. 31st of October 2020. So what was the double entry which was effected in the books of account of this company? So one, we are saying that this company will recognize the right of use asset. This right of use asset should be recognized in the books of account of this company as an asset. So the first account to be debited is the right of use asset. And this account will be debited with this particular amount here, 28.224 million. The other account to be debited is the bank account. Remember, our company sold the asset. The amount which we debit in their bank account is equivalent to the sales profit. Our company sold the asset here. It received an amount of 112. That should be debited in the bank account. Debit the bank account with that amount. Yes. So these are the two accounts to be debited. Then we proceed and credit a number of accounts. The first account to be credited is this one. There is liability. There is liability account. The lease liability will be credited with this amount, 40.32 million. So because this is a liability in the books of this company. Number two, this company will also credit the income statement. So this particular gain on sale, the gain on sale is an income. Being an income, it is supposed to be credited in the income statement. This one, the gain will be credited in the income statement, or basically the statement of a profit or loss. The gain on sale, this amount here, 21.504 million. Yes, that is the other account to be credited. So there is still another account to be credited, because remember what you have accounted for is this. You have accounted for the gain We have also accounted for this one, but you have not yet accounted for this. So once the company sell an asset, then what will happen is that the company will credit the buildings account, will credit the buildings account. Basically, to credit the buildings account is to remove, is to recognize the buildings this building should be removed from the buildings account. That's why we are crediting buildings. So we credit this account with the net book value. With the net book value. How much is the net book value? Is this one? 78.4 million. 4 million. So that was those were the accounting entries which were supposed to be effected on the date this transaction took place. On the date the transaction took place. And the amount which has been debited should be equal with the amount credited. Can you confirm whether this plus this is equal to all this? That should be the case. Because remember, whenever you're making an accounting entry, the amount to be debited, the amount to be credited should be the same. We are saying this should be the same with that. Should be the same with that. Is that the case? Is that the case? Is that the case? Is that the case? Is that what you're getting? I'm getting a yes from Phoebe. I'm getting yes from Faith. Is that what you're getting? Yes, 140. I'm told is 140. 140.224 million. Yes, so that should be the case. So are we done with the question? Are we completed the question what the examiner was requiring? Not yet. That's why you can see the marks allocated here were significant marks, 8 marks. Now, if you check on the requirement, we are required basically to show the accounting treatment of this transaction in the financial statement of 𝐻𝐍 for the year which ended 31st of October 2021. And remember, this transaction, it took place on this date. Basically, this is like this like is it the end of the previous year? Yes, this is like because you can see that this year ended on 31st of October 2021. 31st of October 2021. That is when the current year ended. The transaction took place on 31st of October 2020. So basically, this transaction took place at the end of the previous year, and actually the end of the previous year is the same with the start of the current year. So we can say this transaction took place at the start of this year. But if you check on what we required basically to demonstrate how it was supposed to be accounted for in the financial statement of this company. Now, we need to proceed, and basically we do two things. One, we need to depreciate this right of use asset, because that depreciation for the current year on the right of use asset will be recognized as an expense in the income statement. Other than determining the depreciation on this, we also need to amortize this. So why should we amortize this liability is for us to determine two items: the interest to be recognized in the income statement for the current year, and number two, for us to determine the lease liability to be recognized in the statement of financial position. I think first of all, we can compute the depreciation on the right of use asset, depreciation on the right of use asset, which will be equal to the value for the right of use asset, this one, 28.224 million. And then, how do we depreciate this? We say this one should be depreciated at what? At the shorter of two periods. Shorter of two periods. I hope you can be able to remember those two periods. One, there is term, and number two, the remaining economic life of the asset. The remaining economic life of the asset. So this company 𝐻𝐍 Limited leased back this asset for how many years? 𝐻𝐍 Limited leased back the asset for how many years? In the first paragraph, sentence 2, we are told the building was leased back from the finance company for 5 years. The lease term are 5 years. 5 years. And then you're told the remaining economic useful life of the building were 25 years. 25 years. So we will depreciate this on a straight line basis at the shorter of these two periods. The shorter of these two periods should be 5. So that will give us the depreciation per annum. So what will be the depreciation per annum here? The depreciation per annum, what are you getting? 28.224 divided by 5. So that will give us what? That will give us 5.6448 million. Then where are you getting 1.1? This one should be 5 points. Nekesa, is that figure correct? Yes, which figure are you getting here? Please talk to Mwalimu here. Please talk to me. Please talk to me. Please talk to me. Please talk to me. Okay, yes. So that is basically the figure which you're getting. So remember, this depreciation, this one is an expense in the income statement because we are required to demonstrate the accounting treatment, or basically the accounting treatment for this transaction. We will prepare the income statement extract for the current year only. We show this there as an expense. Number 2, we also need to do what? To amortize this liability. We need to amortize that. And basically, we amortize that by preparing the amortization schedule. There is amortization schedule. There is amortization schedule. So in this case, we have a column for years. For years, then the other column here will be for the lease liability at the start. Take into account our minimum lease rentals are payable in arrears. I hope you can remember that information. The lease rentals in the first paragraph, I think the second sentence from last, the lease rentals are 9856 payable in arrears. So if they are payable in arrears after the lease liability, our next column here should be for the interest, which will be computed at the rate of 7%. The interest rate implicit in the lease. And then the other column here should be for the cash to be paid. That is the minimum lease rentals paid annually. And then finally, there is liability at the end of the year. At the end of the year. Yes. So we start with the first year. The first year ended 31st of October 2021. And we start with the lease liability at the start. The lease liability at the start of the year is what we have here, 40.32 million. Then we compute the interest, which will be 7% of that. What will be 7% of this? 40.32. 40.32 times 7%. 7%. What are you getting as the interest? What are you getting as the interest here? What are you getting as the interest? The interest. I'm not getting the answers. What do I mechoka? Yes, please give me the answers. Stay in the chat box. Please give me the answers. Please give me the answers there. Please give me the answers. I'm waiting for the answers. There. Yes, it will be 2.8224. So how much cash will be paid by our company here? How much cash will be paid by our company, or how much amount do we consider here? The cash paid. The cash paid, remember, is the same with what? The minimum lease rentals payable annually. The minimum lease rentals payable annually. The minimum lease rentals payable annually is, I think, within the last sentence of paragraph 1, which is an amount of how much? Which is an amount of 9 million, 9.856 million. So give me the lease liability at the end. The lease liability at the end, remember, this one is equal to our lease liability at the start plus interest minus the cash paid. This one would be equal to A plus B minus what? Minus C. So what will be the lease liability at the end of year one? The lease liability at the end of year one. This plus this minus that. Yes, what are you getting here? That is 3.2864. That is 3.2864. Yes. So that is the lease liability. Now, in this case, remember, we want to prepare financial statement extract for the current year. So first of all, this will be recognized in the income statement as what? As an expense. But for us to be able to determine the amount of the lease liability, to be recognized in the statement of financial position, we must prepare this amortization schedule for, I think, the next 1 year, such that we have now the lease liability here. Because the lease liability which we have here, remember this one is what we recognize in the statement of financial position as a non-current liability. And then the difference between the two is what we recognize as a current what? Liability. So we must also prepare this for the next year, the year which ended 31st of October 2022. So this closing balance will be the opening balance here. Then we compute the interest. We less the cash paid. So that we get this. How much is the interest for this year? 7% of this. $2.33. Yes. So give me this one. The lease liability at the end of the year. The lease liability at the end of the year. The lease liability at the end of year 2. Lease liability at the end of year 2. Lease liability at the end of year 2, I'm given by Mercy 25.7604. Yes, and I think now having that, we can finalize by preparing the financial statement extract. I want us to start by preparing the income statement extract. Basically, remember, we are preparing this only for 1 year, the year which ended 31st of October 2021. So in the income statement, you have said this company, there were 2 items which were supposed to be recognized here. 2 items, the depreciation and this interest. So basically 2 items were supposed to be recognized here, items of expenses. One of it is the depreciation on right of use asset, which you have computed here, 5.6448 million. And the other one is this interest, this one. The interest, of which this interest we said in the income statement, it should be recognized here as part of the finance cost. As part of the finance cost, which is an amount of 2.8224 million. So this is what our company was supposed to recognize within the income statement. 2 items of expenses. Finally, we prepare the statement of financial position. Statement of financial position. Still, remember, this is an extract. This is an extract. This is basically an extract. So here we have like 3 items. The first one under the non-current assets. Under the non-current asset is this one, the right of use asset. And remember, this is a statement of financial position extract for the year which ended 31st of October 2021. So under the non-current asset, this company was supposed to recognize the right of use asset, of which this one will be recognized here at the net book value. the net book value. The net book value will be equal to the cost, this one, 28.224 million minus the depreciation for 1 year. This depreciation, 5.6448 million. So that will give us a net book value of how much? Will give us a net book value of how much? What will be the net book value for our right of use asset? The net book value I'm told is what? Is 25. Okay, that should be this one. Oh, it's the same. It's the same with this one. No, it is 22.5752. 5752. Yes. So then from there, the next item to be recognized is the lease liability. The other item to be recognized is the lease liability. The lease liability. The lease liability. Okay. So this lease liability, remember, part of it will be a non-current liability. So under the non-current liability here, we will have a lease liability, and under current liability still we will have a lease liability. So remember, we say that the amount to be recognized under the current liabilities here should be the difference between these two values here. Should be the difference between these two values. That difference should be recognized here as a current liability, the amount payable within the next 1 year. The amount payable within the next 1 year. How much is the difference between these two values here? The lease liability at the end of year 1, the lease liability at the end of year 2. The difference is coming to how much? 7.526. Yes, so that is also the figure I'm getting from Maureen. Yes, so then the amount to be recognized as the non-current liabilities at the end of year 1, this one, we said we take the lease liability at the end of year 2. This is now going to be recognized here as a non-current liability at the end of year 1. So this one, 25.7604 million. 25.76.04 what? Million. So that basically what was required in that question. That is what was required in that question, of which you can see that question was a little bit demanding, because basically you needed to recognize all that. You needed to remember all that. That this company 𝐻𝐍 Limited, because this amounted to a true sale, 1, will recognize the asset, number 2, recognize the right of use asset, number 3, recognize the lease liability, and number 4, recognize the gain on the sale. And then from there, you have said that these two items here, the right of use asset should be depreciated at the total of the 2 periods, and then this lease liability should be amortized. Should be what? Should be amortized. And I hope you can see that in this question, the examiner was requiring you just show the financial statement extract for 1 year, because if you're required to show that for how many years? For 5 years, then the question would be involving or would involve a lot of work, because you have to prepare this for the next 5 years. And then when preparing this financial statement extract, for example, the income statement extract, you prepare that for 5 years. The statement of financial position extract, you also prepare that for 5 years. So that's why you can see the examiner just required the preparation of this for 1 year, because you can see the work is quite what involving. So that is it. That is what was required here. That is what was required here. Let me ask, even before we move to something else. Now, if, for example, you're required just to briefly explain how the finance company was supposed to account for this transaction. Remember, we have said that this company, 𝐻𝐍 Limited, we have said was the seller receipt, whereas now the finance company was what? Was the buyer receipt. So in this case, assuming you're required just to explain how this company should account for that transaction. Assuming you're required just to explain how this company was supposed to account for that transaction. So what have we said here? This company will do what? We have said our company will do two things. Who can be able to remember the first thing we have said? The buyer receipt should do. We have said that company should account for the two main transactions. We have said the first thing to be done by that company in its books of account is to do what? To recognize the asset. That is the first thing we have said this company should do. Recognize that particular what? Asset, simply because the control was transferred to this company. So the first thing this company will do is to recognize the asset. And basically, to recognize the asset, this company should simply debit the building's account because it bought the building, and then credit bank because you can be required to basically explain that, and you support that with the accounting entries. So this building was bought, remember, was bought at 112 million. 112 million. So this company recognized that building in its books of account at that amount. 112 debited in the bank in the building, and that is the same amount which was paid to be credited in what? In the bank account. Number two, we have said, other than this company recognizing the asset, the company then will proceed and account for the risk. Account for the risk. Account for the risk. And this company will account for the risk, or will basically have to determine whether this risk is a finance risk, or an operating risk. And basically using the information which are given here. Using the information which we have in this question here. Now, from the finance company's point of view, is this an operating risk or is it an operating risk? From the information which we have here in this question, is this an operating or a finance risk? You have to recall the criteria we discussed in our previous class. Which criteria should be used by the owner of the asset in terms of determining whether the risk is a finance or an operating? Which criteria can we use here to evaluate whether this is an operating or a finance? I can see a criteria there. I think we only have one. Remember, you talked about the option to buy, the transfer of ownership, whether the lessee can be able to use the asset without major modification, whether the present value of the minimum lease rentals is equal to the fair value, and the issue to do with the lease term, whether the lease term, yes, that is the criteria we're going to use, the one which are given by Faith here. That is the criteria we're going to use. Remember, we are told that this asset was leased for how many years? Was leased for 5 years. This is the lease term. We said you take the lease term, divide that with the remaining economic life of the asset. The remaining economic life of the asset, we were told, were 25 years, and then we express that as a percentage. And actually, we say if you get a rate which is 75% or more, that automatically is what? Is a finance risk. If you get a rate which is less than 75%, is an operating what? Risk. Yes. So this will give us what? 1, 5, 1, 2. So this will give us 20%. So you can see here, you can see the rate which you're getting is basically less than 75%. So if it is less than 75%, what does that mean? Is this a finance or an operating risk from the owner's, from the buyer's resort point of view? Is this an operating or a finance? Yes, this one is automatically an operating risk. This one is an operating risk. We have said that if you get a rate which is less than 75%, is an operating. But if you get a rate which is 75% or more, is basically what? Is actually a finance. So therefore, if, for example, you're required just to explain how the finance company was supposed to account for this risk, one, you say it will recognize for that asset, you can support that with a double entry here. Number two, account for that risk as either operating or finance. And you have said, as per the information which you are given here, this risk will be an operating. So if it is an operating, what does that mean? It basically means that this company that is the finance risk will just be accounting for the minimum risk rentals receivable. This company will be accounting for the minimum or for the risk rentals receivable, the risk rentals receivable is basically what? Part of other incomes in the income statement. So the amount of risk payment, which is the 9,856,000, this is what our finance company will be accounting for as an income each year. As an income each year, because this risk does not qualify to be classified as what? To be classified as a finance what? To be classified as a finance risk. So that basically what you need to know. You can see accounting for this a little bit technical from what we have already covered, because so far we have looked on how the risks are accounted for by the owner and also by the lessee. So there was not much complication, but you can see this one is a little bit what? Technical. You need to basically understand what you're doing. So I want just to guide you for that. There is another question which is part of the handout which I've shared with you. Can we go to that question? We are not doing it, but I want to give that as an assignment. That is an assignment. So in the class WhatsApp group, the class WhatsApp group, there is a handout which I've shared there. Yes, is everyone in the class in the paid WhatsApp group? Or we have some new students who are not in the paid group? I think everyone should be in the paid group here. Okay, so are you there in that illustration, in that handout? So if you're there, I want us to briefly go through that small illustration, and then you'll do it as an assignment. You'll do it as an assignment. Okay, so what are we told there? We are told on 1st January 2021, 𝐎𝐍𝐋𝐿 Limited sells an item of machinery to XYZ Limited for its fair value of shillings 3 million. The asset had a carrying amount of shillings 1.2 million prior to the sale. So we are told these sales represent the satisfaction of performance obligation in accordance with IFRS 15, revenue from contract with the customers. So basically, we are told it do what? The sale represents the satisfaction of the performance obligation. It basically means that this particular transaction here amount to a true sale. It amount to a true sale. So if it is amount to a true sale, then you have to remember how the two companies will account for that. So it amounts to a true sale in accordance with IFRS 15. And then you are told 𝐎𝐍𝐋𝐿 Limited entered into a contract with XYZ Limited for the right of use, to use the asset for the next 5 years. And then you're told the annual payment of 500,000 are due at the end of each year. And then you're told that the interest rate implicit in the lease is 10%. The present value of the annual lease payment is 1.9 million, and the remaining useful price of the machine is much greater than the lease term. So if it is much greater than the lease term, That basically information is to help you to know whether this lease is operating or finance from the buyer's resort point of view. So if you're told the lease term, not the lease term, the remaining useful life of the asset of the machine is much greater than the lease term. What does that mean? Should that lease be a finance or operating? Should that lease be finance or operating? Should that lease be finance or operating? So remember, you are told that the remaining economic life of the asset, this one is greater than the lease term. Should this be a finance or operating lease? A finance or operating lease? Finance or operating lease? So remember, in our case, what we are told, this asset was leased for how many years? Are we given the lease term? Are we given the lease term? Yes, the lease term are 5 years. 5 years. 5 years. And actually, we are told that this one is greater than what? Than this one is greater. So does that mean that this lease will be a finance or operating? Because that is information to help you. That is the information to help you. I'm told it is operating. I'm told it's yes. Operating, finance, operating or finance. So remember, in our case here, what we say is that basically this shall be regarded to be a finance lease if the lease term is for the major part, of the remaining useful life, life. But in this case, if you are told this is greater than this one is greater than this, automatically that is an operating lease, because if this is a finance lease, this one should be greater than this one. Sasa? Yes. So this one would be classified as an operating lease. So what are we required to do here? We are required to explain the treatment, explain how the transaction will be accounted for on January 2021 by both 𝐻𝐶 Limited and �XYZ Limited. So basically, number one, you have seen that this transaction here is a true sale, and basically what you just need to say is that that is 𝐻𝐶 Limited, which is the company which sold the asset. Number one, because it is a true sale, it will recognize the asset. Number two, it will recognize the right of use asset. Number three, it will recognize the risk liability. And number four, it will recognize the profit or the gain on disposal. Basically, you have to compute the values which must be computed, especially the gain on disposal and also the right of use asset. Then after doing that, after explaining that, you must make the accounting entries. I hope you can remember the accounting entries which I've made for the other question. Make the accounting entries. Then on the other hand, you will say, because this amount to a true sale, this company which is called XYZ Limited, number one, will have to recognize the asset. So, and basically in that case, support that with the accounting entry. So this company XYZ will recognize the asset by debiting the machine account with the value at which the machine was bought. The machine was bought at 3 million, and then credit bank. Credit what? A bank. And then you will also say that at the end of this year, this company will account for this lease as an operating what? As an operating lease. As an operating what? Lease. As an operating lease. But basically, for you to be able to even understand what you have done here, I will request you do that question. You explain how it was supposed to be accounted for in the books of account of the two companies, in the books of account, and also in the financial statement of the two companies for the first year. The year now which ended 31st of December 2021. So in the books of account of the seller receipt, you will basically have to make the accounting entries in relation to the recognition of the asset, right of use asset, the lease liability, the gain on the disposal. Then from there, you'll have to depreciate the right of use asset. You prepare this amortization schedule for the first year, and then you show the financial statement extract. Then also in the books of account of the buyer as well, after making the accounting entries for the initial recognition, at the end of the year, you have said that company will do what? Will reflect this asset in the statement of financial position. It must also depreciate that asset, and also the lease rentals receivable will be recognized in the income statement as part of the other incomes, incomes. Maybe you can just prepare the financial statement extract in the books of account, or actually in the books of account of these two companies for the first year. Year. Yes, so that basically what you need to know as far as the sales leaseback transaction is concerned. And that brings us now to the end of that topic on leases. So basically, you need to remember what you have discussed here. What is the lease? How the lease is accounted for by the owner, that is the lessor. How the lease is accounted for by the person who is given the right of use asset, that is the lessee. And also how we account for what? The sales leaseback transaction. Especially this one, we have said you need to understand this because you can see it's a little bit more technical. And basically that means that once we meet in our next class, we will be moving to a new topic. I'll be able to see which topic we will start in our next class. We will start in our next class. I'll be able to see whether we do, there is a small topic which is the remaining share-based payment, or basically the topic on external reconstruction, because I think from there, we should be starting the group account anytime from now. But I will be able to see what we will be able to start in our next class. So I want us to stop at that point. I don't know whether there is any question before we wind up. Any question before we wind up? Is there any question before we wind up? Okay, so I think there is none. So we stop at that point for today. Have a nice evening. We continue from there next week on Tuesday. So have a nice weekend and also a nice evening.